there could be a mega financial crisis brewing because, question, what's worse than inflation? Well, if you said stagflation, that's a bingo. You're spot on. This economic nightmare is keeping economists up at night, making inflation, just inflation, look like a walk in the park. Now stick around as we try to figure out if we need to actually worry about the latest predictions or if it's a bit of a nothing burger. We all hate inflation. Inflation sucks balls. It is the boogeyman that shrinks your wallet and makes your handcrafted coffee cost just a little bit more. No wonder people flock to deflationary assets. Obviously, gold recently. Bitcoin, not so much. We tend to be trading more like a tech stock versus an actual sort of gold 2.0 at the current moment. Anyway, year over year, Bitcoin still tends to win long term. But here's the twist. Moderate inflation isn't all bad. In fact, it's a sign of healthy growing economies. But not too much. Just right, the sweet spot. That's why central banks like to aim for that 2% inflation number, which is their sweet spot. It keeps the gears of growth turning while keeping the price tags of goods bearable. When economies expand, people spend more, businesses grow, jobs multiply, and here's the problem. Inflation has a darker, evil twin called stagflation. This robs us of our purchasing power. This is evil. But the similarity kind of stops there in terms of robbing you of your purchasing power. You see, the economic growth remains stagnant or actually gets worse or declines. Because of this, the employment sector will not be doing very well either, aka people are losing their jobs. This isn't just a theory, it's happened before, and according to some analysts, could be experiencing one very soon. Not good. Historically, the most infamous example occurred in the 1970s. The 1973 oil crisis, triggered by OPEC oil price hikes during the Arab-Israeli war, sent shockwaves right around the global economy. Oil, man. In January 1973, U.S. crude oil import prices averaged $2.73 per barrel, but by September, they had surged 23% to $3.38 a barrel. By March 1974, prices hit $11.10 per barrel and increased over the next 5 years, hovering around $13.50 throughout 1978. Inflation, by the way, just year over year, thinking about a $13.50 barrel of oil, it's crazy, man. Anyway, this oil shock fueled massive inflation, which actually reached 12.3% by 1974, while unemployment climbed to 7.2%. By December, GDP growth was at a negative 0.54%, leaving the economy in absolute damn chaos. Now, the UK, for example, faced pretty similar challenges in the 1970s. It was a global event. Inflation peaked at 24% in 1975, unemployment increased, and widespread strikes paralyzed the country. Globally, the 1970s saw stagflation spread, driven not only by oil price shocks, but also by loose monetary policies and the collapse of the Bretton Woods system in 1971. Now, the collapse of this system, it actually made currencies much more volatile and contributed to economic instability worldwide. Now, if you fast forward to 2025, here we are, with the media shouting, the sky is falling, and we're about to experience horrific stagflation, similar to what we saw in the 1970s. Now, this gloomy forecast has caused blue chip S&P 500 to tumble massively, while the tech-focused NASDAQ composite also slipping, both down 2 and 2.7% last Friday. Monday seeing sell-off as well. And look, crypto is not immune. We saw Bitcoin drop from 87K to 81K over the weekend. At the time of recording, not really much sign of recovery yet. Now, before we get into what is fueling the doom and gloom here, quick word from today's sponsor, guys. It's tax time. Taxes suck, but what sucks even more is not doing your taxes properly, and that's why COINTRACKING steps in. Thank you to COINTRACKING for sponsoring this video. Look, managing your cryptocurrency portfolio can feel like a full-time job, especially when you've been trading for years like I have. Heck, I even remember back when I first got into the cryptocurrency markets. I was so excited, but also pretty damn overwhelmed. Keeping track of all my trades, the wallets, all that stuff, taxes, what a nightmare. I had transactions scattered across different exchanges and so many wallets. And every tax season, oh gosh darn, I dread the heck out of that paperwork. That's where COINTRACKING steps in. With more than 1.7 million active users, including 25,000 accountants and corporate clients, This is a game changer, 100%. Whether I need an overview of my profits and losses, or whether I want to generate a tax report, COINTRACKING has it covered. COINTRACKING even supports over 300 exchanges and wallets, so I don't have to sit around spending hours manually inputting all the data, which of course sucks. Plus, it's the cheapest tool out there, and they even offer a free plan for up to 200 transactions. Pretty cool. And the tax reports, they're the most precise in the market, with support for 12 country-specific reports and 15 tax methods like FIFO and LIFO. And if you need more support, guess what? COINTRACKING's full service handles everything from the managing of your accounts to the filing of your crypto taxes. Doesn't get much better than that. So if you want to make managing your crypto easier, then check out COINTRACKING. Use my affiliate link in the description to get signed up for free. And if you go for a paid plan, you'll get a 10% discount exclusively using that link. And if you pay with Bitcoin, you'll get an extra 5% extra off. This is one tool you don't want to miss out on. Link in the description. So let's get back into the doom and gloom stuff, guys. As if taxes don't suck enough, well, we got stagflation coming. So what is fueling the fear, man? I got the fear, man. Well, for one, a recent sentiment survey of Michigan University is showing deep concern that Trump's tariff wars will affect the world's largest economy. So get this. The Philadelphia Fed non-manufacturing business outlook survey. It's a damn mouthful, isn't it? Look, this is something that tracks service sector vibes in the 3rd Federal Reserve District. Well, these guys just dropped an absolute bombshell. Its activity index tanked to minus 32.5 in March 2025, the lowest since the 2020 pandemic. This signals a very major contraction in services like retail and healthcare across eastern Pennsylvania, southern New Jersey, Delaware. Now, I know what some of you are thinking. Oh, it's just a local index, but hold up. This region's packed with some heavy hitters in healthcare, education, and manufacturing. So perhaps this is a sneak peek at what's brewing in the broader U.S. economy. Now, let's talk hard numbers here, because I think it's very important to really dig into the details. The latest reading for the Consumer Price Index shows a 0.2% increase from the previous month and a 2.8% rise in the last 12 months. Another inflation measure here, okay? The headline PCE increased by 0.3% month over month and 2.5% year over year, while the core PCE, which excludes food and energy, increased by 0.4% month over month and 2.8% year over year, up 2.7% from January. And look, this is the Fed's preferred inflation measure, by the way. And I know all these inflation numbers can get pretty damn confusing. There are nuances to all of them, okay? But the bottom line is inflation is higher than the Fed would like it to be. Their target is 2%, and we've seen some ups and downs, basically, in inflation. So we had CPI inflation down, but PCE is up. Problematic. For the job market, the U.S. unemployment rate rose to 4.1% in February 2025, up from January and slightly exceeding market expectations of 4%. Now, as for economic growth, according to the Atlanta Federal Reserve GDP forecast model GDP Now, they're estimating a negative 2.8% quarter, which is destructively bad. In comparison, it was positive 2.4% in the fourth quarter of 2024. Now, let's mash all this crazy economic data together, see what we get. First up, consumers are freaking the F out. Tariff wars are throwing shade on the economy. People are terrified to do basically anything. Pessimism, super all-time highs. People are biting their nails, wondering how it's all going to shake out. Should they just panic sell all their stocks, get out, buy a car? Guess what? The hard numbers aren't doing us any favors to calm those nerves. The CPI, again, inflation number here, is being a stubborn little biatch right now, sticking up around and kind of creeping up slightly, refusing to get back to the Fed's fantasy 2% target number. It's down a little bit recently, but still, you'd think that with this persistent elevated inflation, it's not high. Under 3% is not that high, okay? But with GDP soaring, unemployment shrinking, no. It's the exact opposite. That's what you'd want to happen, but it's not happening. Unemployment is currently climbing ever so slightly, but it is climbing, which is raising fear in the market that we could be staring down the barrel of an unemployment crisis, along with the first negative GDP quarter in over 2 years. Look, we all know inflation's an absolute buzzkill, and stagflation's even worse. It could slam the brakes on our cryptocurrency bull run dreams. But what are the odds it's actually all going to happen? What is the odds that stagflation is going to happen? Well, Bank of America survey found that 71% of fund managers think stagflation is coming for the global economy within the next 12 months. Shit. But some economists are like, yo, chill out. If it happens, it'll be stagflation light, not like the 1970s rerun. I'm kind of leaning towards a milder vibe too, but full disclosure, I don't have a crystal ball, man, so take it all with a bucket of salt here. Look, let's break down stagflation's ingredients. High inflation, high unemployment, and a sluggish economy. Now, compared to the 1970s, 2025 so far looks like a baby. Okay, 2.8% inflation is just a little tiny baby kitten next to the roaring beast of 12.3% inflation back then. 4.1% unemployment is just a little bit off of record lows. That's certainly nothing compared to 7.2% back in the 70s. The Atlanta Fed's GDP now forecast of minus 2.8% GDP is spooky. But the Fed's still betting on 1.7% growth by the end of the year. This is just an initial growth scare at the start of the year. And the New York Fed, complete opposite, 2.8% growth. 2.8% growth, guys. Are these guys even fucking talking to each other? One guy's minus 2.8%, the other's plus 2.8%. Come on. Look, stagflation often comes after some big supply shocks like 1970s oil crisis, but OPEC Plus actually plans to boost oil production in April, which could drive oil prices even lower and help reduce pressures on inflation and make it more likely people are going to hire and do more jobs and all that shit. Tariffs might mess with supply chains. Obviously, this is the big wild card right now, but oil, it's the big kahuna, man, and it's looking good for 2025 so far. So if stagflation hits, and that's a big if, it'll likely be a much lighter jab, not necessarily a knockout punch. And not to say markets are going to like stagflation. They're not. But at the end of the day, we are all just playing armchair economist out here, and we're at the mercy of the Fed and Trump and everything else going on in the global economy, man. Things we can't control. We should just be prepared for eventualities and educate ourselves as much as possible on everything going on. Whether or not stagflation is going to hit us remains to be seen. So take profits on relief rallies and stuff like that when you can. There will be relief rallies. They will be pretty dramatic sometimes. We could still easily turn around at the end of April with M2 increasing. Maybe we have a great run from like mid-April to like start of June or something like that as we follow that big M2 trend up, as we run into the first rate cuts from the Fed and stuff like that. But make sure you're preserving your capital because we're also entering very uncertain economic times, okay? Don't take too many risks. Thanks for watching.